Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we're diving into Voyager Acquisition Corp's latest quarterly report. Spoiler alert, there were some interesting turns involving shares that could disappear and reappear, so buckle up. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can chat about all this too. Alright, this Form 10Q covers the financial period ended in March of 2025. It's basically Voyager Acquisition Corp's report card telling us how they did in the first 3 months of the year. Now, this company is what's called a blank check or SPAC company. They are created to merge with another company that they haven't picked yet. So their financial picture is not about selling goods, it's about managing money and finding a good merger target. Let's get straight into the financials. Total assets, about $262.3 million in March of 2025. That's up from about $259 a year. This increase is mainly because of how they manage the cash they have. Looking closer, the actual cash on hand dropped from about $668,000 to $445,000. But don't worry, most of their money is tied up in a trust account. Speaking of which, the investments and cash held in the trust account increased from $259 $1 million to $261 $8 million. Basically, their investments are making money for them. Now, onto the not so fun part, liabilities, what they owe. Total liabilities increased slightly from $12.1 million to $12.13 million. That includes deferred underwriting commissions, which are fees they will eventually have to pay to the folks who helped them go public. Here is something impressive. They swung from a loss of about $50,000 last year to a net income or profit of about $24 more thanks to the income from their investments held in the trust account. It sounds like they are being smart about managing the trust. Now let's look at shares. The company made about 8 cents per Class A share, which is a basic unit of ownership. This is good growth because last year they broke even. Checking on what's called the Statement of Changes in Shareholders Deficit, it shows that a special type of share, Class A ordinary shares, can be subject to what's called redemption amount. This is basically like saying that these shares can be bought back by the company at a certain price. This also increased by a few $1 million, which is also a good sign. Time to check where the cash goes. They used about $223,000 in operating activities. This is cash going out the door, but it's not necessarily a bad thing. Operating activities are the day-to-day expenses. There were no deferred offering costs, which are the expenses related to launching the company. In the statement for last year, there were over $200,000 in cost. Now, the report does mention they are a blank check company, meaning they are looking for a business to buy. They haven't started operations yet, and they depend on making income from the cash they have in the trust account. So until they find a company to merge with, their main job is managing money and looking for a good target. The report mentions they have enough money to cover expenses for at least a year, and that the public offering brought them a lot of capital, which is good news. They consider investments that mature in 3 months or less as cash. This just tells us how they define what is cash on hand, which matters when you are dealing with millions of dollars. Here's a very important detail. The company had to determine if their warrants, which are basically options to buy stock, should be accounted for as part of what they owe or what they own. They were able to classify it as what they own equity, which simplifies accounting and also is a good accounting choice by the company. A private placement is basically when a company sells shares or warrants directly to investors. And in this case, a good amount of warrants went to Cantor Fitzgerald and Odeon Capital Group, LLC. This section talks about the sponsors. This is usually a key part in a SPAC filing because related parties have to act fairly, so it's always good to see them mentioning it. The report says that some of the Class B shares might need to be returned, depending on if the banks backing them buy more units in the company. They made sure they won't transfer any stock to anyone until they make a deal or a year passes. Here's another related party detail, one that's common with SPACs. Voyager Acquisition Corp pays up to $10,000 a month for office space and admin support. This goes to Voyager Acquisition sponsor Holdco LLC, which is like the company's parent. The report talks about things that might happen in the future, like the right for some shareholders to register their shares, meaning make them available for public trading. It will cost the company money to do this. The banks who help take the company public get a percentage, some now and some if they close a deal. So that is another liability for the company. And finally, a huge announcement. Right after the close of the quarter, they agreed to merge with Biotech AG, which is a Swiss company. Basically, Voyager is trying to make a deal happen, which will form a new company in Switzerland. Now, looking at these results more broadly, Voyager is in a pretty standard position for a SPAC. Their profits are almost entirely due to where they park the money in the trust account, which has benefited from good yields. However, with the recent agreement to merge with Viraxa Biotech, it will be interesting to see this company start to turn into more than just a SPAC. Alright, that's our breakdown of Voyager Acquisition Corp's latest filing. What's your take on these numbers and what they signal for the company's future and their merger with Viraxa? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description where we discuss this and other companies. Thanks for watching. See you next time.